answering your questions about retirement. It's Money Talk with Michael Eastham.
I'm 68 and retired. What's better for protecting my principal and income right now, CDs or an annuity?
Well, it's very important to understand that when you're thinking about both CDs and annuities, they have some similarities and they have some differences. And it's important to understand those distinctions before you make a determination as to which one, if either, is appropriate for you in your retirement strategies. So let's talk about the similarities first. The first similarity is that both banks which issue CDs and insurance companies which issue annuities, they both have a safety net or a guarantee. The banks are backed by the FDIC, whereas the insurance companies provide a safety net through the state guarantee fund. So it's that guarantee that you have that your principal is not going to disappear. The second similarity is that both banks and insurance companies, they have a business model that is a for-profit business model. That means that you're going to invest money with them and they might provide you a minimum guarantee of 1 or 1.5%. And then they're going to loan that money out in the form of loans, right? So they may take your money, pay you 1%, and loan that money back to you at 7% for a car loan or maybe a mortgage. And you see, they make money on that spread. We don't fault them for that. It's just their business model. Then we talk about the differences. Now, some differences that I think are worth considering are that generally because of the way that insurance companies invest the money that is invested with them, they're able to generate a little higher interest rate than banks do on CDs. So that's one of the reasons you'll see those differences with a similar duration. A second piece is that interest that's earned on an annuity is tax deferred. In other words, you don't pay tax on it until you take that money out. So it could sit there and grow and earn more interest, and you don't have to worry about taxes as long as you don't need the money. That's a key distinction. Another distinction is that CDs don't provide long-term guarantee, but annuities can. They can provide guaranteed income for your lifetime. So when you think about all of these factors that go into determining, hey, is a CD appropriate or is an annuity appropriate, you must understand these similarities and the distinctions. And then you have to factor in, the current environment. Typically, when you're in a higher interest rate environment that we've been the last couple of years, CDs can look really attractive, right? But now we're starting to see the interest rates go down, which means that bank CDs are going to drop very quickly. Annuities are still going to drop as well. You're going to see the interest rates that insurance companies pay start to go down as well. So keep that in mind. If you have a great rate on a CD or on an annuity, on a fixed product, then maybe now's the time to lock that in for a 3-year or a 5-year period. But I can tell you that with interest rates declining, these are going to become less and less attractive. Well, I hope this answer helped. Please make sure, if it did, that you like and subscribe so that you don't miss next week's question as well. Thanks so much.